For 7 years, the Facade held perfectly. A successful pharmaceutical executive, a luxury home in Westchester County, quarterly vacations documented in carefully curated social media posts. The surface narrative suggested stability, prosperity, and partnership, but facades, no matter how meticulously maintained, contain structural vulnerabilities. And in this case study, the fracture arrived not through suspicion or gradual erosion, but through a single photograph sent to the wrong phone number. This isn't a story about infidelity. This is an analysis of how one woman's discovery of romantic betrayal became the entry point to exposing a sophisticated, multi-year federal tax evasion scheme. Now, let's open the case file and deconstruct the plan. The wife, a corporate attorney with 15 years of litigation experience, received the photograph at 11:47 p.m. on a Tuesday. Her husband, traveling for what he described as a regional sales conference, appeared in the image at a beachfront restaurant. The woman beside him was not a colleague. The body language, the proximity, the intimacy of the framing these details required no interpretation. What elevated this moment beyond conventional marital crisis was the wife's professional training. She didn't confront, she documented, screenshot, metadata extraction, reverse image search to establish location and timestamp. Within 40 minutes, she'd created a preliminary evidence file. The initial 72 hours followed a predictable pattern. The wife contacted a divorce attorney. She secured separate legal counsel for asset protection. She began the standard discovery process: bank statements, credit card records, mortgage documentation. The operating assumption was straightforward. Romantic infidelity would lead to divorce proceedings, property division, and the dissolution of a marriage. The mistress, identified through basic social media investigation as a 9-year-old marketing consultant, appeared to be the antagonist in a familiar narrative structure. 2 women, 1 man. The conventional framework suggested conflict, rivalry, and emotional warfare. But the wife's forensic approach to evidence gathering, a professional habit honed through years of corporate litigation, would soon reveal that the photograph was not the crisis. It was merely the indicator light on a control panel, concealing a far more complex system of deception. The wife retained a forensic accounting firm on day 4, standard practice in high-asset divorce cases. The initial scope was routine: trace marital assets, identify separate property, establish a baseline for equitable distribution. The accountants requested 7 years of tax returns, banking records, and corporate financial statements from her husband's consulting business. The husband complied without resistance, a decision that would prove catastrophic. The first anomaly appeared in week 2. The forensic team identified a pattern of quarterly wire transfers, each just below the $10,000 federal reporting threshold, moving from the husband's business accounts to a corporate entity registered in Delaware. The LLC's name was generic, deliberately forgettable. But the transfer schedule was precise: $9,800, executed on the 15th of every 3rd month for 6 years. When we analyze structuring behavior, the deliberate segmentation of transactions to avoid currency transaction reports, we see intention. This wasn't accounting error. This was financial architecture designed for opacity. The accountants traced the Delaware LLC to a subsidiary account in the Cayman Islands. The balance, $12.4 million. For context, the husband's reported annual income over the same 7-year period totaled $2.1 million. The discrepancy wasn't marginal. It represented a complete secondary financial ecosystem, operating parallel to the documented marital estate. The wife's divorce case had just intersected with potential violations of the Bank Secrecy Act, the Foreign Account Tax Compliance Act, and federal tax evasion statutes. Here, the narrative ruptures. The wife faced a strategic decision point. She could proceed with divorce litigation, using the offshore account as leverage for a favorable settlement. Standard approach. Predictable outcome. But the magnitude of the fraud suggested something more dangerous. If her husband had concealed $12 million from federal authorities, he had also concealed it from her for the entire duration of their marriage. This wasn't infidelity with financial complications. This was organized financial crime that had weaponized their marriage as cover. The forensic accountants recommended immediate legal separation of assets and consultation with a white-collar criminal defense attorney, not for the wife, but to understand her exposure risk. The husband's tax returns, filed jointly, bore her signature. If federal authorities initiated an investigation, she wasn't just a betrayed spouse. She was potentially a co-conspirator. The revelation transformed the case architecture entirely. The mistress, still operating under the assumption that she was the romantic rival, became relevant in an unexpected capacity. The wife's legal team discovered that the husband had purchased a condominium in the mistress's name 18 months earlier, $780,000 property with no mortgage, no documentation of gift tax filing, and no disclosure on federal tax returns. The mistress wasn't just the other woman. She was an unwitting participant in a pattern of asset concealment that now threatened her with legal liability. The true antagonist had been revealed, and both women were in his blast radius. The initial contact occurred on day 23. The wife's attorney sent a formal letter to the mistress, not a cease and desist, not an accusation, but an information disclosure. The letter outlined the offshore account structure, the undocumented property transfer, and the potential federal liability now attached to the condominium title. The message was clinical. You are not my opponent. You are a co-victim in a financial crime scheme, and your legal exposure requires immediate strategic response. The mistress responded within 6 hours. She retained counsel, and within 48 hours, both legal teams were in the same conference room. This moment represents the critical strategic pivot that transforms conventional divorce litigation into collaborative justice architecture. The expected narrative, two women competing for resources, attention, or vindication, collapsed entirely. The reframing was explicit. The husband had constructed a financial crime infrastructure that weaponized both relationships as concealment mechanisms. The appropriate response was not rivalry, it was alliance. The strategic objective crystallized quickly. Build an evidence package sufficiently comprehensive and legally robust to trigger immediate federal investigation, while simultaneously protecting both women from accessory liability. The timeline was set at 90 days. This wasn't arbitrary. Federal whistleblower provisions under the IRS and SEC programs require substantial, documented evidence of fraud, not allegations, not suspicions, but actionable intelligence supported by primary source documentation. 90 days provided sufficient time to construct that architecture without alerting the target. The alliance established a division of labor based on access and expertise. The wife controlled the marital financial records, 7 years of joint tax returns, and banking documentation. The mistress had access to the husband's personal communications, travel records, and critically, his unguarded conversations about business operations. Both women had fragments of the operational picture. The 90-day project was forensic reconstruction, assembling those fragments into a prosecutable narrative. Week 1 focused on asset mapping. The forensic accounting team, now working for both clients under a joint engagement agreement, traced the full network. The Delaware LLC connected to 4 additional shell entities. The Cayman account fed into a Singaporean investment vehicle. The architectural complexity suggested professional tax planning. The husband had clearly retained specialized counsel to construct this system. The accountants identified $18.3 million in undeclared assets across jurisdictions, representing approximately $4.1 million in evaded federal tax liability plus penalties and interest. Week 2 introduced the legal framework analysis. The team consulted with federal tax attorneys and a former IRS Criminal Investigation Division agent, now in private practice. The objective: understand exactly what evidence thresholds federal agencies require to initiate audit and criminal referral. The IRS whistleblower program requires documentation showing substantial tax deficiencies, generally interpreted as exceeding $2 million. The case cleared that threshold immediately. But triggering investigation required more than showing the deficit. It required demonstrating willfulness, that the taxpayer knew of the obligation and deliberately chose concealment. This is where the mistress's contribution became essential. She provided 14 months of text message records. In those communications, the husband explicitly discussed keeping the offshore accounts clean, staying under reporting limits, and maintaining the structure through the LLC screen. These weren't ambiguous business communications. They were direct evidence of intentional tax evasion. When combined with the structuring pattern, those precisely calculated $9,800 transfers, the case for willfulness became overwhelming. Weeks 3 through 8 comprised systematic evidence organization. The team constructed what federal investigators call a prosecution-ready package, documentation organized chronologically, indexed by legal violation, cross-referenced to specific tax code provisions. Each shell entity received its own subfile: incorporation documents, account statements, transaction logs, correspondence. The wife's litigation experience proved invaluable here. She understood evidence authentication, chain of custody requirements, and admissibility standards. The package wasn't just comprehensive, it was courtroom-ready. The psychological dimension required careful management. Both women were navigating active relationships with the target while conducting covert financial investigation. The alliance implemented strict operational security protocols. Communications occurred only through encrypted channels. Document transfers used secure file-sharing platforms with automatic deletion after access. Neither woman altered her behavioral patterns with the husband. The wife maintained the facade of standard divorce proceedings, contentious, but focused on marital asset division. The mistress continued the relationship without indicating awareness of the criminal exposure. This operational discipline was critical. Any indication of coordinated action would trigger defensive asset movement or evidence destruction. Week 9 introduced the strategic sequencing analysis. The team mapped out the cascade effect of simultaneous filing. The IRS whistleblower submission would trigger audit assignment within 30 days. The SEC filing focused on the husband's misrepresentation of assets to his pharmaceutical company, which had granted him stock options based on disclosed financial status, would initiate corporate investigation and potential securities fraud review. The divorce filing, submitted with full disclosure of the offshore assets, would create immediate court jurisdiction over asset preservation. When executed simultaneously, these 3 filings would create a legal tripwire. Any attempt to move, conceal, or liquidate assets would constitute additional federal offenses. The final 2 weeks focused on verification and redundancy. Every bank statement was cross-checked against source documents. Every wire transfer was traced to both origin and destination. The team built 3 complete copies of the evidence package, one for the IRS, one for the SEC, and one for the divorce court. Additionally, they created encrypted backups stored in separate secure locations. The principle was simple: eliminate any single point of failure. If one submission was delayed, lost, or challenged, 2 others remained active. By day 88, the architecture was complete. The package contained 847 pages of financial documentation, 34 exhibits of electronic communications, forensic analysis reports totaling 156 pages, and a 47-page memorandum mapping each document to specific violations of federal tax and securities law. The submission wasn't a complaint. It was a blueprint for prosecution. The alliance had transformed scattered indicators of fraud into an irrefutable case file. The intellectual satisfaction wasn't in the exposure of infidelity. It was in the precision of the strategic construction, 90 days of methodical evidence architecture designed to trigger an irreversible cascade of federal accountability. Day 91 began at 6 a.m. The wife's legal team filed the divorce petition in New York State Supreme Court, accompanied by a motion for immediate asset preservation and full financial disclosure. The filing included a 23-page appendix documenting the offshore account structure, the shell entity network, and the pattern of systematic concealment. The court clerk timestamp: 9:02 a.m. At 9:17 a.m., the IRS whistleblower submission was electronically filed through the agency's secure portal. Form 211, Application for Award for Original Information, accompanied by the complete evidence package. The submission identified $4.1 million in tax deficiency, provided documentation of willful evasion, and included the forensic accounting analysis establishing the 7-year timeline of structured transfers. The IRS whistleblower office confirmation receipt arrived at 9:19 a.m. At 9:34 a.m., the SEC submission was filed through the Office of the Whistleblower's online system. The complaint alleged securities fraud based on the husband's material misrepresentation of financial status to his employer, a publicly traded pharmaceutical company, which had granted him equity compensation based on disclosed net worth statements. Those statements had omitted $18.3 million in foreign assets. The SEC confirmation, 9:36 a.m. The simultaneity was not coincidental. It was strategic architecture. Each filing created independent legal authority for asset investigation. Each agency operated under different statutory frameworks with separate enforcement mechanisms, but collectively, they formed an interlocking system of accountability that eliminated escape routes. The husband couldn't move assets without alerting multiple federal agencies. He couldn't claim ignorance when the divorce filing demonstrated the wife's documented knowledge timeline. He couldn't negotiate settlement when criminal referral was already in motion. The cascade began within hours. At 2:47 p.m., the husband's attorney received service of the divorce petition by process server at his office. At 3:15 p.m., the husband called the wife. The conversation, anticipated and prepared for, lasted 4 minutes. The wife's response was scripted by counsel. She confirmed the filing, declined to discuss terms, and referred all communication to her attorney. No emotion, no explanation. Pure information control. By 5:30 p.m., the divorce court had issued a temporary restraining order preventing asset transfer, encumbrance, or liquidation, pending the preliminary conference. The order covered all accounts, domestic and foreign, identified in the wife's filing. The husband's access to the offshore accounts was legally frozen before he fully understood the scope of exposure. The federal response operated on a different timeline. The IRS whistleblower office assigned the case to the Criminal Investigation Division within 12 days. Standard protocol for submissions exceeding $2 million in alleged deficiency with documentary evidence of willfulness. At day 103, 2 IRS special agents made contact with the husband's business address. They delivered a formal notice of audit and a summons for records production. The audit wasn't a review. It was a criminal investigation predicate. The SEC moved more slowly, but with equal precision. At day 118, the agency opened a formal investigation file and issued document preservation letters to the pharmaceutical company and the husband's business entity. The company's compliance office, facing potential secondary liability for inadequate vetting of executive disclosures, immediately placed the husband on administrative leave pending internal investigation. The mistress executed her strategic exit during this window. On day 94, she had already vacated the condominium and terminated the relationship via attorney letter. Her legal team had negotiated proactive cooperation with federal investigators providing communications evidence in exchange for written declination of prosecution. She transferred the property title back to the husband through quitclaim deed, formally severing her connection to the asset concealment scheme. By day 120, she had relocated to a different state and begun employment with a new firm, her legal exposure resolved through strategic early cooperation. The execution phase demonstrated a core principle of strategic justice. Velocity creates irreversibility. Once the cascade initiated, no amount of legal maneuvering could arrest the momentum. The husband retained white-collar criminal defense counsel at substantial cost, but the defensive posture was fundamentally reactive. The evidence package had already established the narrative framework. Federal agencies were operating from prosecution-ready documentation. The husband's legal team wasn't constructing a case, they were attempting damage control on a structure already collapsing. By day 150, the IRS had identified an additional $2.7 million in unreported income through secondary forensic analysis. The criminal referral to the Department of Justice Tax Division was filed at day 167. The takedown wasn't theatrical, it was mechanical, procedural, and utterly comprehensive. The federal prosecution concluded at month 22. The husband pleaded guilty to 7 counts of tax evasion, 2 counts of filing false tax returns, and 1 count of failure to report foreign financial accounts. The plea agreement, negotiated to avoid trial, carried a 63-month federal prison sentence, $6.8 million in restitution to the IRS, and an additional $3.2 million in civil penalties. The sentencing memorandum explicitly referenced the comprehensive evidence package provided by the whistleblowers as the foundation for prosecution. The federal judge, in her sentencing remarks, noted that the case represented a sophisticated, multi-year scheme of deliberate fraud that required equally sophisticated detection and documentation. The asset recovery process moved through parallel channels. The divorce settlement, finalized at month 18, awarded the wife 72% of the documented marital estate after accounting for the fraudulent concealment and the wife's role in federal recovery. The offshore accounts, seized by the IRS, were liquidated to satisfy the restitution order. The Delaware LLC and subsidiary entities were dissolved through court order. The pharmaceutical company terminated employment and clawed back $1.4 million in equity compensation granted based on fraudulent financial disclosures. The wife's financial position post-settlement exceeded her pre-divorce baseline. Beyond the asset division, she received the IRS Whistleblower Award, 5% of collected proceeds, totaling approximately $1.1 million, the SEC Whistleblower Award of $340,000. But the more significant outcome was structural. She had transformed a position of vulnerability into one of strategic advantage through methodical evidence construction and alliance formation. The mistress's trajectory diverged, but followed the same principle of strategic repositioning. Her proactive cooperation with federal authorities eliminated criminal exposure entirely. The quitclaim deed transfer protected her from civil asset forfeiture. She relocated, established her consulting practice in a new market, and within 18 months had exceeded her previous income level. Her participation in the alliance, rather than remaining isolated in a compromised relationship, converted potential catastrophe into strategic exit. When we analyze this case study, the intellectual satisfaction derives not from the punishment of the antagonist, but from the architecture of collaborative justice. The conventional narrative 2 women fighting over a man would have produced a predictable outcome. Protracted litigation, divided resources, emotional exhaustion, and likely inadequate accountability for the underlying fraud. The strategic pivot recognizing shared vulnerability and constructing an alliance transformed scattered disadvantage into coordinated power. The 90-day evidence package represents the core lesson. Justice in complex financial crime cases doesn't emerge from emotional reaction or adversarial positioning. It emerges from systematic documentation, strategic patience, and the intellectual discipline to construct prosecution-ready evidence. The alliance didn't just expose fraud. It created the legal architecture that made federal intervention inevitable and comprehensive. This case deconstructs the fundamental assumption embedded in stories of romantic betrayal, that the appropriate response is rivalry between women. That framework serves the perpetrator by keeping potential witnesses divided and reactive. The strategic alternative alliance, coordination, and forensic collaboration dismantles that protection. The intellectual license we grant ourselves isn't for enjoying personal drama. It's for appreciating the precision of strategic justice. When properly constructed, accountability becomes mechanical, procedural, and irreversible. The transformation from betrayal to strategic alliance, from scattered vulnerability to coordinated prosecution, demonstrates a principle that extends beyond individual case studies. The architecture of justice doesn't require extraordinary resources or unique circumstances. It requires clarity about the true adversary, intellectual discipline in evidence construction, and the strategic wisdom to recognize when collaboration produces outcomes impossible through isolation. This wasn't a story about infidelity. It was a case study in how methodical analysis, forensic precision, and strategic partnership dismantle systems of fraud that depend on silence, division, and shame for survival.